Amen, amen, amen. Thank you all for coming. Again, for those of you who may not be familiar with us, this is Believers Hangout. So in Believers Hangout, we meet weekly. We are actually a non-denominational ministry with a goal of exposing the love of Jesus to as many as possible in the world, while also helping them to build intimacy with the Holy Spirit, all while living purpose-driven lives. So the goal of Believers Hangout is not just our spiritual edification, but our all-round success. And part of that mandate also is to part of the main mandates on us is to do everything we can to make sure that people have all the necessary information, both from scripture and from experienced individuals, to be able to live effective and efficient lives. And that was actually the vision behind the Financial Wisdom series that we've been having. This is the second month right now in a row. And for those of us who were in last month's edition, I'm sure we're really, really blessed. So today is going to take a little different dimension. I'm not going to do all of the talking today. We have an expert in the house. Actually, we're going to have two guests today, but our first guest is Terry Reyes. I'm still going to give her the chance to introduce herself. This is just like a soft introduction. Her name is Terry Reyes. She's a mortgage professional. This is literally what she does for a living. I know last week we talked about, and just in a general sense, about just real estate investing and obtaining your residential properties. But this week specifically, we're going to dive deep into the mortgage process, what it takes to get approved and all of that. And who better to do that than someone who does this every single day for a living. So Terry, over to you. Please kindly introduce yourself. Tell us a little about yourself so we can get to know you better. Thank you for coming, by the way.
Hello, everyone. Can you see me?
Yeah.
Am I coming up?
Yeah.
Can you see? Yep, good. Hi, I'm Terry Reyes. I work with Stockyards Bank, and I am in the mortgage division. I've been in the business 19 years and have helped many individuals achieve the American dream, including Richard, and help them purchase a home, go through the process, which is a lot. So it's very important when I deal with individuals to explain everything to you, so that at the end of the day, I always say, when you go to the closing table, you can turn around and you can talk to your friend and tell them all about the process. It's very important. It's one of the biggest purchases you'll ever make in your life. So it's very important you understand that process.
Yeah, awesome. Thank you so much for that intro. Sorry, did you have something else you wanted to add?
No, I'll wait for you to ask me.
Oh yeah, sure. I mean, this is mostly just a conversation, so feel free if you have any insights you want to throw in, even if I don't ask, just feel free and just go with the flow.
Yeah,
so
I'll go by
that.
I'll go by the itinerary you gave me.
Okay, that's fine. So I just want to say this up front for the participants. Please, if you have any questions at any point, please drop your questions in the chats. So that way we're going to have probably at least 20 minutes at the end of the interview for us to take those questions. So as Terry does her thing and she just goes on and she's talking, if you have any questions, just drop them in the chat. I'll collate those questions, so that helps us to save time. We can ask similar questions together, and so she can address those as we go. But Terry, for those who may not be familiar with what a mortgage loan officer does, which is what you do, can you just tell us a little bit about what you do as a mortgage loan officer, and just give us an overview?
So the main thing is that I do is, when you approach me that you want to be pre-approved for a loan, I would ask you certain questions to make sure that the criteria is met with regards to employment history, status, and things like that before we get going. After I decide whether it sounds like we'll be able to move forward, then there's three ways that I offer. We have an online application. You can come into the office, or you can give me the information. I will input it in the system myself. So my responsibility is to gather information, create the loan for you. There are many different loans, so not one fits all. So it just depends on your scenario. It's case by case. So that's my responsibility. And also my responsibility is to make sure the process goes smooth. I gather information from you along the way. I do have a team that work with me, a processor that helps gather conditions. And we all do this together and make it to the closing table. But pretty much it's my responsibility to get the ball rolling and make sure that you are in a position to get pre-approved. I know there's a lot of information out there that you read on the internet or you hear from others, but it's important to get with a loan officer first, because you have to get pre-approved before you even go out and look at a house. A realtor is not going to take you out to see a house unless you're pre-approved. And then you have to have that letter in hand if you want to write an offer. So very, very important. I am your first process. I'm the first step in this process for you.
Awesome.
And then once we get to a point where, and that usually doesn't take me long. Once I get the information, I can, get information in the system. I can, in 15, 20 minutes, depending on the workload, and I can call you back and we can talk about everything and go from there. And the agent send the pre-approval letter to them, and then you can start looking for a home. Now, I can pre-approve you for a certain amount, but you might not want to pay that much a month. So that's a question I asked you as far as your budget, your personal budget, where you would like to be. And then we'll start from there and see where that fits into a mortgage for you. It's no good telling you you can be pre-approved for an extra year budget. So that's another layer that I have to go through with you.
Okay, that was pretty comprehensive. Thank you for that.
Yeah.
So if you didn't get that, Terry is the first person you talk to if you're trying to buy a house. So the first step is not to go around, disturbing property owners. They're probably not even going to pay attention to you, unless you have that pre-approval letter. And that is what, a mortgage loan officer will help you to do. She goes through all of your docs, and then she gives you that letter, which basically tells whatever realtor you're working with or seller that you're serious, you're not just goofing around, you're really interested in buying a house and you are pre-approved up to a certain amount. All right, so Terry, I know a lot of people on the call may not be familiar. For those of you that don't know, Terry already introduced herself earlier when we started this webinar. She works at Stockyards Bank. I know Stockyards is in Kentucky, but I'm not sure how many states where you guys are. Can you shed more light on that, where you're located, and then, just give us a little bit of background about Stockyards Bank.
Stockyards Bank has been around since 1904, and it was established in Louisville, downtown Louisville. Just a little history. Back in the day when everyone would come on their coaches and there were no cars, and there was a place called Stockyards downtown where they would butcher the meat, the animals, and get the meat. And so the farmers would come in on their coaches and they would bring cash to buy animals and to do trade and so forth. And so Stockyards thought, well, we need a bank down here so people can put their money in the bank and they don't have to carry cash around them with everywhere. So that's how they started. That was the idea. And that's why we're called Stockyards Bank. We are licensed in 38 states. So we can do business in 38 states. Branches, we have 73 branches in Kentucky, in Indiana, and Ohio. So regional branch wise, we're in the region of Ohio, Indiana, and Kentucky, with obviously the most being in Kentucky and in Louisville. So if you're not familiar, you probably will be now, because you'll be driving along and you'll say, oh, there's the Stockyards. So, that's how life works, right? You don't notice things until you're told about them, and then you see it. I am in the Middletown branch. I oversee a couple of other branches. It doesn't mean that if I were to meet with you, you have to come all the way here. I can meet you, pretty much wherever we need to go. It is preferable, obviously, if you can come here, but I'm also very flexible.
Okay, awesome. And I just want to put this disclaimer out there real quick that this is not a paid interview. I'm not getting paid in any way whatsoever to do this. And this is not any sort of advertising. The only reason why I decided to bring on Terry was because I worked with her, during my home purchase process, and I really had a really good time. And I just felt it would be an opportunity to give more people the opportunity to take advantage of what I took advantage of. So this is not a promotion, this is not advertisement, and I am not getting paid. So just let's get that really crystal clear for those who might be curious about that. All right, I haven't
And
said.
I do these everywhere, Richard. I do home buying seminars everywhere.
Yeah,
So
I just
it's
needed to
just
say
not
that
for
just so it's
individuals
clear
from
and
all
it's out
walks of
there.
life.
Yeah, yeah, I
No,
know.
you're good.
Yeah, this is
You're
America.
just a good person.
You have to put
That's what
disclaimers
you
out there
do.
just
That's
so
complete.
there's no confusion. All right, so
I know.
so now that we've spoken a bit about that, can you tell us a bit about the type of mortgages or loan types that you guys offer, and just give us like a brief overview, like what does the interest rate look like what are the loan products that you provide for someone, like if someone wants to buy, say, like a residential property, or someone wants to get just purely investment properties, like what kind of loan products, mortgages do you guys offer?
So let's start a little bit with the way the rates are right now. I know a lot of you probably see in the news or you hear, about the Fed, the Federal Reserve. They raise rates and then we go up, and then they talk about lowering rates and then they don't do it. And our our rates are up and down. They're all over the place right now because every time they speak, it affects the market. It affects us. We've been through COVID, and for those of you that have been here since then, maybe some of you have not. Fortunately for you, maybe you have not been here. But because of that, rates were very low during COVID because it was a horrible time, really. So for the country, for the world, for everywhere. And that's the only time those kind of things happen, which obviously is not normal. So everyone that was in that time knows the rates back then, but that is not the norm for the United States. It's probably where we are right now is pretty close to the norm. The inflation rate is high. I know things are costing a lot right now. We haven't had to deal with that before like we have now. But as far as rates are concerned, we're right around the normal where we should be. My first in 1980, mine was 16%.
Wow.
So we've all been through different times, yeah. Yeah, so now we're in the sevens, right? So between that and now you can understand that's how volatile and that's how it changes as time goes on. So right now we're in a really good situation, even though they seem high, they're really not. But we offer, there are many different loans, and I'm not going to try to confuse you because it can become very confusing. But there's what they call a conventional loan, which that. And then there is an FHA loan. And let me remind you that when I told you before, I take your information and I create the loan that works for you. So it just depends on what loan works best for you. But there's an FHA loan, and that is 3.5% down. And then there's a veterans loan. There is rural housing that's outside Jefferson County or outside Jefferson County. That's 100% loan. And then there's down payment assistance programs for you to up to $10,000. It's not given to you. You have to pay it back, but it is available to you if you need that towards a down payment. We do have a loan. Stockyards has their own loan called Right at Home. And that's 100% loan. That means you have no down payment. and it's a 620 credit score. You just can't have owned another home. You can't own another home right now. So when you close, you can't have ownership in another home. That is a very, very popular loan right now because it's hard for people to come up with money for a down payment. So that's been a very popular loan for us. And that enables you to get in with no money down and only really closing costs are there, but you can, if you work with a good realtor, you can ask the seller to pay some of those closing costs to offset that. So there's a lot of people, including Americans, that just don't, they think you have to have 20% down to do a loan, and that's not correct. It depends on the loan type that you are doing. That particular loan, you can't have any collections or 30-day lates other than medical in the last 12 months. Other than that, everything is good to go. But if you don't fit in there, then I take you to a 3% down and go from there. So, or we can do the down payment assistance. So as you can tell, there's a lot of ways that you can get a home. It just depends on what fits you the best.
Awesome.
And these are 30-year, there's 30-year loans. There's 30-year, 15, 20, 25. Okay. Most people do 30-year.
So in case you missed it while Terry was speaking, there are several ways. The number one challenge that I notice people have, or the excuse people give why they don't even want to think about getting a house, is the idea, oh, I don't have a lot of money. I don't, based on what I've read, I need to have like 20, 30 or $40,000, saved up and all, and that is just completely not true. Okay, like Terry said, there are so many ways you can go about it. There are down payment assistance programs that can help you, pay off or pay down part of your down payment. And there are actually loan packages that require no down payment. And as far as the closing costs goes, and I'm still gonna ask you, Terry, a little about that. As far as the closing cost goes, you can actually, by law, negotiate with your seller to pay a portion of your closing cost. So while on the subject of closing costs, I want to just ask you that real quick, Terry. Can you tell us a bit about that? Like, what are the things that go into your closing costs? What's like an average range of closing costs to expect? Say, if you want to buy a house that is probably like $150,000, like how much closing costs can you expect to pay? What's in that closing cost? And how can you get your seller to pay part of your closing costs, if not all of it, and what percentage can they pay?
Well, the closing cost consists of the fee that the lender charges. We charge $7.95, which is the cheapest I've seen around. Not because I work there, but because I see a lot of things come across my desk, and it's very minimal. The other including in that is the attorney fees, because they have to do title searches. They have to do a title search on everybody involved in the transaction, including the realtors, and make sure that everything is good to go, so that when you close on that home, there will be no any outstanding liens or anything on that property. Also, there's a credit report fee that when we pull credit, there's a flood cert fee to make sure your house is not in a flood zone. And there are title insurance fees along with title insurance. There's lender's title, which is mandatory. Everybody has to have lender's title. That protects the lender from anything goes wrong with the title of the home. And then there's owner's title, which is not mandatory. However, it's preferred, because let's just say you purchase a home and that seller had some work done on their home before you purchased it, and you buy the home and then they didn't pay the person. So now the home is yours, and that person can come back and say, I didn't get paid. I need to get paid $2,000 that I never got paid. And that goes against the house. They'll put a lien on the house. And so that homeowners or that owner's policy protects you from that throughout the time you have the home. So it's recommended, it's not mandatory, but I would say 99% of the people take it just because of the liability that could be there for you down the road. And it's a one-time fee at closing. The other part is the recording of the deed and the mortgage, which is the closing attorney does that. The second step to that, those are closing costs. The second steps are what they call prepays. And in the prepaids, you have 1 year of homeowners insurance that you get. You are the one responsible to get that. That is included in that. And also, we set it up so that when you close, your payment is not due for 2 months. So you skip the next month, and then the following month is your first payment. So that way we calculate how much we're going to have to need in your escrow account, which is where your taxes and insurance money are going to be. It's like a savings that we set up. And so we put so much in there to begin with as a cushion. And then when you start making your payments, in your payment is that payment every month, so that when the taxes and insurance come due, we have enough money to pay that for you. So those, when you say closing costs, it's closing costs and prepays are all involved in that. The actual amount of closing costs, well, actually everything really depends on the purchase price, because the title insurance is based on the purchase price, and the loan amount is based on that as well. So $150,000 home, you know, depending on the insurance, you're looking probably at about $4,800. But
we're kind of breaking a
in
little
a conventional
in there.
loan,
Can you repeat that?
factor that Richard was talking about, and that would leave you only paying about $300 out of your pocket.
Hey, Terry?
Which part?
Yeah, just like the last 30 seconds.
Yeah, I'm here.
We're kind of frozen. Just apart from the estimate, like if you had $150,000 house, like you were estimating, yeah.
Where did I end up?
You were kind of like giving an estimate of what it would cost for the closing cost, and that was where you kind of
okay. So if you have $100,000 home, you know, $4,800 or $4,800, and then according to the rules of the loans, then you can have up to 3% paid for by the seller, and that's the negotiating that you're talking about. So now you're talking $4,500, right? 150 times 3 is $4,500. So that offsets what you have to bring to closing. Depending on that loan I talked about, the 100% loan, you have to have $500 of that out of your pocket in that you have to put. It's called earnest money. When you write up a contract, they have a deposit to say that you're intending to proceed. You can use that money, and that's all you need to have. So if you come out with everything's paid for and you don't have a down payment, then you have to have at least 500, and that's it. The rest of it is, you don't have to have anything. So it depends on the loan. Depends on the loan.
Awesome. So for those who missed that, what she was basically saying was, if your total closing cost is $4,800, for example, and you're buying $150,000 property, the seller is able to pay up to 3% of the purchase price of the property as your closing costs. So, and I believe this is for conventional loan, right, Terry? Does that apply to FHA as well?
This is conventional. If you go to FHA, it's up to 6%.
Which is even more awesome.
So see, it depends on the loan.
Yeah, so basically, let's take a conventional, for example. So if your seller is willing to, they call it seller concessions, right? So if the seller is willing to concede up to 3% of the purchase price towards your closing costs, so that means the seller is paying $4,500 out of the $4,800 that would have made up your closing costs. So out of pocket, you're only bringing in about $300. But like she was also saying, you need to put in at least $500 out of pocket. You can use that as part of the earnest money deposit, or for other stuff. But personally, I just think that's really awesome. And while we're still on the subject, Terry, can you tell us a bit more about the 0% down program? Like, what's the requirements in terms of the income, in terms of the property type you can buy with it? What's like the maximum loan about? Just things like that.
So the maximum purchase price is $275,000. Maximum loan amount is $275,000 because it's 100% loan. The income is based on county. So I'm going to send you a flyer on that, Richard. So in that flyer, it has all the different counties. And then there are different incomes based on each county. 80% of the median income in each. That loan, now this is our loan we're talking about, the 100% loan. I can take the income of one if both of you together is more than that, then I can use just income of one person and qualify you that way. It's only the person that's on the application. And also, if you have base income and then you have overtime, a lot of people are working overtime these days. So if you have base income and then you have overtime on top of that, and you have bonus or commission, and it throws you over that amount, I don't have to count that. I can just count your base. So there's a lot of wiggle room there to try to make it work. The main thing that you have to make sure if you're going to go for that 100% is that you look for a home in those counties. And that's something I would talk to you about at the time. But there's a lot of counties. I mean, it's not just Jefferson County, it's Shelby, it's Oldham, it's, outside of Louisville and Indianapolis up to Indiana, as far as Indiana. I mean, we've got them everywhere. So, but it's important to know that.
Okay.
One thing I wanted to bring up, Richard, just before I forget, if you don't mind.
Sure.
These are little things that I run into. These are things that you need to look out for when I'm taking applications. So cash is not acceptable in a mortgage transaction. We do not accept cash. So if you have a deposit in your account of $2,000 and you have $5,000 in your account, but a deposit in there says $2,000 and it's cash, then that reduces the amount you have in your account to $3,000. We do not, we ask for 2 months bank statements, the last 2 months when we're taking application. So if we have these 3 months from now, if you have cash, go ahead and put it in there so that when we go back the last 2 months, we won't see that deposit in there, but you'll have that money in there. Big deposits have to be sourced. So be careful with that, because I know a lot of people hold cash. But if you're saving up to buy a house, you don't want to save it under your mattress. You don't want to save it in the safe. You want to put it in the bank. But make sure you do it prior to those 2 months, so you get credit for it, right? And then there are a lot of people doing this, and I don't know if this applies to anyone on the call, but there are a lot of people doing these buy now, pay laters, this Klarna, and all these things have come up in December where you can buy something and pay it 4 months from now or pay it 12 months from now. Be careful with that. Get into that. Then the main thing is that you have to, when you're starting this, the least debt on your credit report, we go by the debt. So if you have a credit card that you've spent $3,000 on, you don't want anything, your monthly payment is $50, then that debt goes against your buying power. So the less debt you have, the better. I could speak an hour on credit, Richard, but credit is extremely important in this country. So it's important to have a credit score. If you don't have one, go to the bank, get a secured credit card, start doing that, start getting a credit score. And always, never late, never 30 days late, and always keep your credit limit, could be $1,000. Don't ever charge more than 30% of that. So don't ever charge more than $300 on that account, because that's when your credit score starts to go down. So, and they want you to keep using it. So I just tell people, if you have credit cards and you just manage them well, use them for the purpose of having a good credit score, not to go out and get something you really don't need. And now you've maxed your credit card out, and that's not good for your credit score. A collection for a medical collection, a collection for anything can drop your score as much as 50 points. So you have to be very careful. Very careful.
Okay. I'm sure, many of us are getting a lot of value from this conversation. Please, if you have any questions at any point, just feel free to drop them in the chat. So at the end, probably in the next 10 minutes, we'll stop with the interview and we'll just take the questions so we can get all of our issues addressed. But while we're still on the conversation, so I know you already spoke on, the mortgage application process, but can you just give us maybe like a 1 minute rundown of what it looks like if someone is trying to apply for a mortgage? Like, what are the steps? Just like the run through. Well, what are they? What can they expect to be doing?
Um, so what they would expect, I would add, the application consists of your name, your social security, your date of birth, where you work, how long you've been working there, how much you have in the bank, that kind of thing. And I would obviously run your credit during the application process. And then also I would always ask you for your, how much you make. And I always ask for pay stubs, generally the last 30 days of pay stubs and the last 2 years of W-2s and any ID documentation that you have along with that. And those are the things I usually ask up front just to validate that everything you've told me is correct. There's a lot of variable income out there right now since COVID. So not everybody's working 40 hours a week. They're working 39, 37, 40. And that causes a little bit of an issue. But the way we get around that is we ask for more information and then we average your income versus just base it on 40. And then I will talk to you about what we can do, the loan and everything, and talk to you about the cost. And then after that, when you go out and if you get a contract on a home, then I will make sure all the information is up to date, because not everybody just goes out tomorrow and finds a house, right? It could be a month has gone by and you haven't found the house that you want. So I have to update maybe your pay stubs or something like that. And then once that happens, it goes into our underwriting department, and they will check everything that I have in there and calculate the income, make sure everything is correct, and get in touch with you and let you know what conditions we need to have, what extra things we need to make this loan work. During that process, in the beginning, I ordered title from the title company, as we talked about earlier on the closing costs, to get that ball rolling. The appraisal, I do not order it right away, because you are technically probably going to do inspections on that property first, which we don't require, but it's something that will tell you a lot about the bare bones of that property, what behind the walls, what's going on, anything they see. And then once you come to an agreement with the seller, if you're okay with it, or you're going to ask for repairs, then that process happens. Once everybody's in agreement, then I order the appraisal, because the appraisal is a cost to you. So it's part of your closing cost, but it is a cost. So you don't want to order the appraisal before the inspections and then all of a sudden decide that you really don't want that house, and now you have to pay for the appraisal. So once you tell me, yes, we're good to go, then I go on and do that. And then once we get the appraisal back in, during that time, which takes about 8 to 10 days, we'll be working on conditions with you. And then we get to the end where we put your conditions back in along with the appraisal and the title work. And hopefully at that point, we'll be ready to close. Closings happen within 30 days normally. Shouldn't go beyond that unless there's an issue with an appraisal or something like that they have to go back and forth with. But normally you're talking about 30 days.
Okay. Sorry, I'm having a little technical challenge here, but if you can still hear me, I'll just go ahead and ask you.
I can hear you.
Yeah, the next question I have here. So thank you for that information, by the way. So I
Sure.
want to shift gears a little. Just I know we've been talking mostly about residential. If someone was interested in getting, say, just a purely investment-oriented property, how does that differ in terms of the requirements and the process to, say, like a residential property?
The investment loans are typically at the minimum 15% down. The more you put down on those, the better rate you're going to get. Since COVID, the investment property rates are not really not like they used to be. Usually, if you put less than 20% down, you're going to be paying to get the rate you're getting. You're going to have to pay extra to get that. But if it goes beyond that, then usually we can give you a rate and you don't have to pay extra. Whenever you pay extra, it's called points. So if you, just word of warning, if you are out there, say with another lender, and there's something called APR, you will see your interest rate is your interest rate, and then there's something called APR. The difference between those two is what your closing costs and prepays are. So if there's a big difference between the two, then you know there's something up, because it shows you that there's more cost there than you know. So what's going on right now is a lot of lenders out there that I'm seeing are quoting lower rates, and then the people go for the rate, but they don't, and the loan officer is not telling them that they've just paid $2,000 to get that rate. So no points is where you want to be. I can talk to you about buying down the rate, and you can pay points to get down, but no points is where you want to start. Just be careful, because it's out there everywhere right now. And I've saved a couple of people lately from paying a lot of money that they didn't know. The loan estimate is what tells the story of every loan out there. It tells all the costs involved. Those points are on there. So be careful. The investment properties, the rates, they used to be typically a half a point higher. They're higher, a little higher now. You will pay higher than the normal rate for a primary per residence on the investment properties, but at a minimal 15% down.
Thanks so much for that information. And I don't know, in case some people missed that. So basically what Terry was saying was that if you're trying to get a lower interest rate, sometimes lenders can allow you to pay upfront a certain amount, and that's what the point is all about. So you can pay like an extra $2,000, and then your rate can drop, say, from maybe 8% to like 6.5 or 6.25 or whatever. But the important thing is just pay attention to what all of the loan information, the loan estimates ahead of time. I think Terry also mentioned that when you reach out to a mortgage loan officer, they should give you a comprehensive loan estimate that gives a breakdown of what your rates are, your monthly payments, and all of that stuff. And just pay attention to all of those details, because I had a situation also, in my time where I was basically getting quoted for, the same information, and one lender was, quoting a closing cost of $10,000, right? While, I think at the end of the day, the estimate Terry gave me was, way below $5,000, and I didn't even have to pay up to that at the end of the day. So just pay attention to all of those little details, because they can really make a huge difference. All right, so let's shift gears a little to immigration status. So I know there are a lot of people on this call, who are not yet permanent residents, or they're not yet citizens. Some are still international students. Some are recent graduates, So in terms of, say, if someone, like me, an international student, for example, who currently does not have, the official EAD card and all of that, if they still want to go ahead and buy residential property, what kind of documentation do they need to present to satisfy basically that need?
That's a little gray, Richard. I would have to see, there's so many statuses out there and so many visas that people are here in the States on. Typically, if you're here as a student on a student visa, that's not going to give you enough to purchase a home. So I would almost have to have the individual send me the visa that they're on. I mean, we have people here in asylum, they're in asylum status. A lot of that is here. Refugees that have come in, they have that status, and then they get the EAD, obviously. But there are other visas out there. There's DACA, there's things like that of the children, that's another entity. So it's a case by case. I would have to see if someone has a certain visa that they could just, if we're talking, they could send that to me and let me take a look at it and make sure that that can be done. Because a lot of those I-9s, they're a 3-year thing, and then you have to renew it again.
Mm-hmm.
So we have to establish something going forward. And everything is case by case. That's all I'm going to tell you, because there are so many different visas out there. So if somebody is on the call that is thinking about purchasing and they have one of these visas, I'd be happy to talk with them and look at that visa and let you know for sure that that would work.
Yeah, thank you so much for that. I think that's a really important point because many people don't even bother to take the step just because they already concluded based on what they read on the internet that, oh, I'm not qualified, I can get a mortgage. But it's like she was saying, it's not always cut and dry. So if you're not sure, you have nothing to lose, just reach out to a loan officer, give them your profile, let them know what's going on, and then they'll do their due diligence. And then they'll tell you, oh, this is going to work, or this is not going to work. So I think that's really, really important, regardless of whatever your visa status is. But one thing I've just discovered just from my experience is as long as you can work legally, as long as you're able to pay back the loan, you can show you're making enough to pay back the loan. Usually, most of the time, you will get approved. But again, I'm not a professional, so like Terry says, it's case by case. So definitely schedule a call, with her, or doesn't have to be her, any mortgage professional really, and just get your case evaluated so you're not really basing your decisions on assumptions. So get facts, not assumptions. All right. Thank you
And
so
much. Richard, let me hold on one second. One more thing. I keep thinking about things. Sorry.
Sure.
But about the interest rates. Interest rate, aside from the 100% loan, every Friday we evaluate that rate. That's based on the market for the week. All other loans are based on the market daily. So you can call someone and say, what is your rate for this? And they can say, well, it's so much, it's on a Monday. And then you call me on a Tuesday and that rate's not there anymore because the market has gone bad or whatever it might be. So if you are trying to compare rates, you need to do that the same day because that's how you're going to know what the rates are. And you need to give them your scenario because not everything is just black and white. It's different loans, like I've been telling you. It depends on the loan. Right now, I could give you a rate, depending on the loan, anywhere from the high sixes to the high sevens. And it just depends on the loan that you're getting and what you qualify for. So that's very important for you to know. Just don't assume that one rate is the rate everywhere all the time.
Yeah, I think that makes a lot of sense because I struggle with that a bit also, but I later got to understand that rates, it just depends on who you talk to basically and what parameters they're using. So finally, Terry, thank you so much for your time and your wealth of information and knowledge. Can you please just share your contact information if someone wants to reach out to you? How can they reach you basically so they can get their cases evaluated?
Okay, you can reach me at my name, Terry.Reyes at SYB, Stockyards Bank, SYB.com. My office number is 502-259-2301. And my cell phone number is 502.
Can you repeat the office number, please?
I'm sorry. Oh, 502. Okay. 502-259-2301. And my cell phone number, which is you can reach me on that any day, anytime, any day of the week, not just during bank hours. 502-807-4771.
Okay. Awesome.
It's important. You're looking at houses on weekends. You're talking about things on weekends. Sometimes you just have to make myself available to you, just like the realtors do, because it takes a team to make this happen. And if you're not available, we can't. It won't work.
Absolutely, I agree. All right, thank you so much for all of your time and all of the information.
You're welcome, my pleasure.
So I did promise we we're going to have a few minutes at the end of the talk to address questions. So I have a few different questions here. I'm just going to go through them one after the other. I noticed some of them you've already addressed in the course of your, as you were speaking. but there are still a few here that I still want to just read real quick. So someone says, what if the money is coming as a policy loan from a universal life insurance policy? Is that acceptable?
So forms of assets, which could be many different things, could be a certificate of deposit, it could be a 401k. Yes, it could be cash values from an insurance policy. We would just have to prove, we would just have to give me the documentation showing me that it's there. And then when it's transferred, there's a way to do that. You can transfer that into your account and we can count that. You can also have gift money from an employer or a family member. That is something that we can do, but I don't want them to give you the money before the transaction. It would be during, because there's a process to do that as well. So there are ways to, yes, that is definitely accessible.
Okay, awesome. So another question here says, thanks for the talk. Do you have branches in New York? I think the answer to that is no. It says also,
I don't think we're in New York.
okay. Also, it says, is St. Lawrence County part of the counties you mentioned? I'm not sure where that is specifically. And then it
I
says,
haven't heard of that one.
yeah, it says, lastly, can we have your contact? I think you already addressed that. But you mentioned something, Terry, that although you have branches in only a few states, you are licensed to operate in, like you said, 38 states, was it?
Yeah, there's only maybe about 7 or 8 states that we're not licensed in. And I can send you this information if you would like to share that with all that are on
Yeah,
the
sure,
call, Richard.
sure.
I'll send you that information. I'll send you information on the flyer that we talked about that had the 100% and the income limits on that. And then on the flyer, the 100% loan, you will see at the bottom right, you'll see all the counties that loan only. If you want a conventional loan in South Carolina, I can get you that. In Florida, I can do that. Do you see what I mean? But for that 100% loan, we have to do that in the counties where we have branches.
Okay. Okay. So just to answer that person's question, in case you missed it, yes, you can buy houses, you can get conventional and other loans, even in other states outside of Kentucky and Indiana. But if you're looking specifically for the 100% loan package, that's only available in specific counties around Kentucky, Indiana, I believe Ohio. So just put that out there. Also, someone says, you mentioned that the income sum or total can go as low as what? So I think what this person is asking is like, is there like a minimum income that you can make in order to qualify for, I don't know, maybe the 100% loan?
A minimum income?
Yeah, like just a range of income.
Well, I mean,
And
that's hard to say because it depends on.
just to comment on that, I think I want to say this also, that it depends on the kind of house that you're trying to buy,
Right.
right? If you're trying to buy a $500,000 house and you're making 25,000 a year, obviously that's not gonna work, right? So I think from my experience also, it just depends on the kind of house that your income, and like Terry was saying, your debt to income ratio will greatly influence what the maximum loan amount you can get from a bank would be. So if you run your documents to Terry and she looks at all of your information, your debts, your assets, your income, and all of that, she can now say, all right, based on what you have right now, the maximum loan amount you can get will be maybe 200,000 or 100,000 or 50,000, right? I mean, that's my understanding. You're welcome, Terry, to add to that.
Yes. No, that is correct. Everything is based on your income. So there's no too much or too little. It's just that it's based on your income, on how much you can afford. So, it's hard to get, I can't give you a certain amount. The main thing you have to remember is the less debt you have on your credit report, the more buying power you have. Because just to give you an example, if you earn $2,000 a month And then we qualify you for that. You can buy you can pay $1,000 in a mortgage because it's not dollar per dollar. It's a percentage of what your gross is a month, not after taxes, before taxes. So if we take out that, and then we have, okay, say now we're at 1,000, and then you have a third of $500 car payment. Well, guess what? Now you can only do $500 mortgage payment. So the less debt you have on your credit report, the better, the more buying power you have.
Okay, awesome. So the next question here says, does this apply to condominium purchases as well? Or is there a different process for that? I think this person is asking about the 100% loan.
Yes, you can do a condominium. We can do condominiums. It has to be a primary residence. It can't be an investment property, but we can do condominiums. We can do, you don't have to be a first-time home buyer. We can do manufactured homes as well. And I don't know, does anybody here have the I-10? Do you have any people that have the I-10
I think there
number?
might be a couple.
Okay, we are just now rolling out that loan. And that's a 20% down, 620 credit score. Just to throw it out there. So we didn't have it before. It's very hard to find that loan, but we have brought it out now. So
is that a Stockyards product, or is that a regular conventional?
It's Stockyards is doing it. It's not a portfolio. We are going to sell it out, but we're able to do it. Not many lenders want to do it. So everybody's always called me about it, and I just said, just hold on, we're doing it. So we just yesterday they rolled it out. Awesome. So if anybody has an I-10 number, you can now do that. You just have to have a 20% down, because an I-10 number is not really a visa to be in the country. So there is more of a risk involved. So that's why they make it a 20% down a loan. But it is available, so you can buy a house.
I think that's amazing, really, because that just opens a world of opportunity to people who have no social security number. And I just think that's awesome. So if there's anyone on the call, if you know anyone who has just an I-10 number, they don't have an SSN, but they have a job or whatever, they make income, please share this information with them. I think it's gonna be a real lifesaver. All right. So I think we have a couple more questions here. It says that there are options for two independent people who aren't married to jointly apply for a mortgage, like two friends, for example, and they want to bring their income together to apply for a mortgage. Is that possible?
Yes, you don't have to be married, and it doesn't limit to two people. It could be three people on there, but you don't have to have a relation. You don't have to be related. It can be a friend. So yeah, and it's also that the thing is, everybody that's on the loan has to live in that property. That's the key. You can't bring in somebody. I believe on the FHAs, you can do a non-occupying co-borrower. So we can do that on some of the conventionals. We can do that as well. On the 100% loan, you can't. They have to be living in the house.
Okay, just a follow up to that, Terry. So for the 100% loan, do they have to live there forever, or just for a certain amount of time, and then maybe in the
It's like any loan. It's like any other loan. It's a 30-year fixed. I mean, or whatever you want to do it at. They can sell the house in 2 years.
Okay, so what I mean is, so you said they all have to live in the house, right? That's at the point of closing. But let's say 1 year or 2 years down the line, they all maybe move out of state and they want to convert maybe the house to like an investment property and then go buy another house. Is that something they can do?
We don't monitor that, Richard. I mean, people do that all the time. Okay. They'll move into a house and then they'll find another house and keep that house and rent it. It's what the purchase is when you purchase the home. It's what its intention is for. That's where you start. That you have to be within, there's questions that are answered by you saying that you will occupy this property. So it's not something that you can just say you're going to be in, but you're not. You're checking a box.
Yeah.
Saying you're going to be in there. So, but it didn't say, are you going to be occupying it for 30 years? No. Are you going to be occupying the property at the time of closing? Yes, you are. We don't have any way to really know. I mean, obviously, you don't want to use this as a tool to do something that's not correct, right? Because then you get in trouble.
Yeah.
But if down the road, 5 years down the road, you move out of state, but you want to keep that property and rent it out, there should be no problem with that.
Awesome. And I just want to say this, that, in my case specifically, I remember in part of the contract, it says there that, all right, do you agree to live in this property for a minimum of 1 year? Right. And I thought, okay, that makes a lot of sense. Right. So just to throw that out there for those who might be curious, except in specific situations where you have like down payment assistance programs that have other rules. I know there are like down payment assistance programs that'll tell you, oh, you can't, you must live in the house for at least 5 years, at least 10 years, or you're gonna pay back the amount of down payment assistance you're receiving. But if that is not the case, I think in most cases, just within a shorter period of time, if you eventually have to move, I think that should be fine. So everyone, can we please appreciate Terry for her time?
Hold on, Richard. Hold on. Excuse me 1 second.
Sure.
It's just talking about the down payment assistance. Down payment assistance and grants are two different things. Grants don't have to be paid back. And when you have something that does not have to be paid back, then those 4 or 5, whatever years that comes into play. So there's a grant that comes out during the year in March usually. So that grant it's 5-year forgivable. So after 5 years, you don't have to pay that back. If you leave in 4 years, then 1 year of that, which would be 1,000, would go down on your bottom line. You would get $1,000 less at closing. Do you see what I mean?
Mm-hmm.
But those grants and down payment assistance, those are two different things. I mean, they can be called that, but they're two different animals. So you have to be careful with that. But we are doing also, we're doing a 1 year work. Usually we ask for 2-year work history. We are doing a 1 year work history right now. It can't be that you had a job for 2 months and went to another job and went to another job. If you're on the job for a year or more, but you're not at the 2-year mark, we are doing those loans now. They look at your credit to make sure your credit is good and, some assets in the bank, but you don't have to go 2 years necessarily. And in that, there is a loan out there. I'm not going to get into the details, but there is a $2,500 grant within that loan as well if they qualify for 50% less of the median income, which is about $44,000 a year. So as you can see, there are so many
options. Yeah.
Yes, a lot of options. Right.
Thank you so much, Terry. We really appreciate it.
You're welcome.
I'm sure everyone learned a great deal. And for those of you who may want to reach out to Terry, we've dropped her contact information in the chat box, so feel free to reach out to her, just to get a personalized evaluation of your specific case. Thank you so much, Terry. We hope to have you on
You're welcome.
all the time.
Have
all right,
nice
with that, we're going to move to our next guests. We have another amazing guest here tonight. So our first guest is more of a local lender around this area, just Kentucky, Indiana area. But our next guest has more of a national territory, and they also have very amazing mortgage products. The point of this webinar today is just to give us hands-on, practicable. The idea behind today's webinar is just to put you in a position where once we're done, you can literally pick up your phone and you can reach out to either of these guys and just begin to get your case evaluated, and then you never know, in the next 30 or 45 days you could actually be in your own home. So that's where we're going the extra mile to really bring the experts who do this for a living. So you don't have to run around doing a Google search, trying to figure out how can I get a mortgage. These are the guys that actually, they do this for a living every single day, and they're ready to talk with you, just immediately after the call. And like I said, this is not a sponsored video. This is purely educational, and it's for our benefit. And I just hope we'll take advantage of that. So our next guest name is Rob Verne. I'm still going to allow him to introduce himself. This is just like a soft introduction. Rob works at Rocket Mortgage, for those of you who may be familiar with that, and he's been doing this for a while. Thank you so much, Rob, for coming on. Can you please just give us a brief introduction? Tell us a bit about yourself.
Hey, thanks, Richard. Hello, everyone. Yeah, my name's Rob Byrne, and I do work with Rocket Mortgage. I've been a mortgage loan officer now since the year 2000. So I've been doing this my 24th year. I originate loans in Ohio, Kentucky, Indiana, Michigan, Pennsylvania, Florida are the states that I primarily work in. And we work with all different kinds of scenarios. Our bread and butter products are going to be our products that we typically do. Most of our loans are going to be your government as far as FHA, VA, and then our conventional products, Fannie Mae, Freddie Mac, which are the when you hear a conventional loan, those are the two backers of those types of loans. With the Fannie Mae and Freddie Mac, on a first-time home buyer, you can sometimes qualify as low as 3% down. And then we do have another in-house product that goes along with the 3% that you can qualify for, a Rocket grant of 2% towards your down payment. And with that grant, with Rocket, there is no time period that you have to maintain the house. So you can buy that house and sell it a year later, and you're not paying back it. That money is completely free to you if you're able to qualify. But as far as myself personally, live in Cincinnati, Ohio. If you've ever been up here, I live right by Kings Island. Grew up in Cincinnati and very familiar with the tri-state area with Ohio, Kentucky, Indiana. This has been my playground for 51 years now.
Awesome.
Married, have a 10-year-old daughter, and just pretty much it.
Awesome. That's a comprehensive intro. We're glad to know a little bit more about you.
A little long.
You're good. So basically, I want us to just zero in a little just on Rocket. So right now, like, I know there are lots of people on this call from different areas, different states, and they may want to buy properties in different places. And I know you may have specific states where, you have like your branches and all of that. So are there specific states that people can buy properties in, or they have to live in to be able to use a Rocket mortgage? And is that only specific for Rocket products, or all of your loans in general, like FHA or conventional? Like where are the areas that you serve?
So with Rocket as a company, we serve all 50 states. And we can, if I'm not able, or if I'm not licensed to originate in that state, I can hand someone off to somebody that's looking in a particular state to be able to help them, which is a nice thing. One of the other things with Rocket, being as large as they are, they understand that our country, we're welcoming immigrants and people from all over the world on a daily basis to our country. And so we've got tools set up. We've got translation lines that we can access. If someone is not very, if English is not a comfortable language, we can get a translator on the phone to go through and go over documentation. Right now, as far as on the paperwork, which is a little bit more unique as well, is that if someone is Spanish speaking, we can have everything put together paperwork-wise that'll be in Spanish, which makes that easier as well. I'm sure there'll be more languages as time goes on and the population becomes more and more diversified for those things. And plus the advent of AI, artificial intelligence, is also going to make this process for people that are not native to the United States a lot easier, because AI is going to be able to handle a lot of that communication gap, and quickly. I think even quicker than a translator would be able to. So those are some kind of cool things that are on the horizon. But as far as your ability, if you're I don't know if most people here are in Lexington or Louisville, but if you're looking to buy a property in another state, that's completely doable. You know, if it's investment property or if it's going to be a primary residence, you just go through the normal application process and have to meet those qualifications. But it's pretty simple, pretty standard. FHA product and VA product can only be used for primary residences. So you can't use those products to buy investment property. But once you, with like, for instance, with VA, if you're a veteran, you'd have to be a veteran to use that product. But if you happen to be a veteran, you can use the VA loan and hold on to existing properties that you already own with the VA loan and take out another VA loan down the road, as long as your intentions are to move to that property. For anybody who is looking to buy property though, or let me back up, if you happen to get started with an FHA loan, there are requirements in order to hold on to that loan. You have to be moving at least 100 miles away if you're going to try to use FHA again. And also with FHA, if you're going to try to hold on to that property and rent it out, in order for that payment to be removed from your debt to income ratio without a history of rental income, you do have to have a 25% equity in the property in order to move that payment out of the debt to income ratio. Otherwise, if you are moving 100 miles away and you need to use FHA product, you can still do that. You just have to include that departing residence in your debt to income ratio. I don't know if that makes sense. The debt to income ratio basically is the debt that you have outstanding, and including the new loan that you're looking to take out up against the income that you've got coming in or will be having coming in.
So Rob, to kind of interject you there. So if someone says, for instance, they bought a house and let's say it's a single family and they live there for a year using the FHA loan, and then after that they decide to rent out the property and then go somewhere else and go buy another one. So basically, are you saying they can use the rental income to offset their debt to income ratio for the next property?
Yes, but the caveat there is, in order to hold on to that property and move to another one, in order to hold on to that and be able to have that payment removed, or to have the rent that's going to be coming in to cover that payment on that property, you have to be either going with a conventional loan the next time, or you have to have at least 25% equity in the property. So, circumstances, obviously, you know, if you're putting 20% down when you buy that first one, but you still are going FHA, not a problem. But typically with FHA, usually, you know, you're either using the product because of the credit score or the debt to income ratio, and then it can also be because of the assets that you have available to you at the time. So having that payment become something that is removed from debt to income ratio, if you're having to go FHA again, is a little difficult. Just because of the fact that it's going to be hard to be at a 75% loan to value, or lower.
Yeah, and just to interject you there, so for those who may not be familiar with the term, so the equity in your house is basically the portion of the value of the house that it is not owed, right?
Correct.
To another person, say like a bank. So if based on the appraisal today, the value of your house is $100,000, but you bought the house, maybe you even bought the house for say $80,000, right? Or you bought it for $70,000. In reality, your equity on that house, if you bought it for $70,000, or maybe at the point you bought it, you know, the value was $70,000, right? And then you bought it for $70,000. But in 1 year, the value of the house increased to $100,000. Now the equity in the house is $30,000, assuming you still owe the $70,000. So that's what Rob is kind of alluding to there when he's talking about 25% equity and all of that. Thanks so much for that, Rob. The next thing I want to basically ask, and you kind of touched on this a little, is can you just tell us a bit about the different loan packages you have? What does the interest rate look like right now? And just give us an overview of that.
So interest rates are a fun conversation because they're fluid on a daily basis. The other reason is because an interest rate, there's many variables that go into a rate. Credit score is going to be one of them. The amount of money you're putting down on a house or on that loan to get on that house to lower that loan amount. So if you're putting 5% down versus 15% down can affect your interest rate. You've also got the length of the loan is going to be a variable, and the purpose of the loan. So are you buying a primary residence, or are you buying a property that you plan on renting out? So all those factors are going to go into it. With that, and then plus you've got your conventional product versus your government-backed product, and those are going to change what rates look like as well. There's a couple of programs that can offer you better pricing. For instance, if your income is below what they call the area median income limit, if it's below the 80% limit for the area, then you can get better pricing than you would on, and this is for conventional loan, than you would if your income's above it. The cool thing about that income limit is if there's, let's say your job is paying you a base salary of say 60,000, and then you get bonus income of another 20,000. If you can qualify for that property based on just the 60,000, then we don't include the 20,000 that you make every year from bonus. Or if you're buying the property with someone else, a spouse or anybody, then we can, if all the debt and the income of one person qualifies, then we can just use that income and remove the other income so that you're able to stay below that threshold. Right now that threshold's getting a little bit tight, and they usually update the numbers here coming up in June, where they will reevaluate what the area median income limits will be. So that's a good thing, because those numbers are going to definitely go up here starting around June, to where that 80% number is going to be higher than it was, and it should be a pretty decent change, I would think, because of inflation. If you give me an address, Richard, I can show everybody what I'm referring to when it comes to the area median income and how you can look that up.
We can use Louisville, Kentucky.
You got you have any kind of address? Okay. It's asking for a, well, let me do this. I think I can now. Let's just use this. Let's do here. This is going to be a Michigan as an example. So let me see if I can get the share screen going here.
I gotta make you a host. Hang on. Hosts. Okay, you should be able to share a screen now.
Okay. Oh, still disabled.
You should be enabled. I just made you a co-host.
Okay, there it goes.
Yeah.
All right, so everybody see looks like a map right here?
Yeah.
All right, so in this area, this is up near Detroit. It's a suburb out in Michigan. And as you can see in this little spot here, let me back up or go to the top left corner. This is what I did. It's the Fannie Mae Area Median Income Lookup Tool. I'm going to throw in an address up here, and then this is going to pop up. And what it's going to show me here is this 80% area median income. So for this area of the country, in this area of Michigan, 76,960 is the 80%. So someone buying a home in that area that has their income less than 76,960 will qualify for one of the products, which I'll talk about in a second, but they'll qualify for the Home Ready, because the Home Ready does not require that you're a first-time home buyer. So you'll get better pricing in those circumstances. There's another product that Rocket has that's called Rocket One, which is for home buyer or first-time home buyer program, where one of the borrowers has to be a first-time home buyer. And in that situation, Rocket's going to give you a 2% grant, which is, again, free money. So if you qualify for the Home Ready product with your income, you could theoretically buy a house with 3% down, and then Rocket's going to give you 2% of that 3, so that you actually only need to bring 1% of the down payment plus whatever your closing costs are. Or if your seller agrees to pay closing costs, you could be buying a $200,000 home essentially for $2,000 out of pocket, depending on what
That's
the seller.
That's, sorry to cut you off. That's
No,
2%
you're good.
of the purchase price, right?
Yes.
Okay.
Yep. So this is the tool. Again, you can Google it. It's the Fannie Mae Area Median Income Lookup Tool. So I'm going to go ahead and stop the share on this. But back to, you were asking about pricing, about the interest rate. So as of Friday, if the rates on a conventional loan with you're looking at I'm going to digress a second here. Every interest rate comes with both it either comes with a credit, what they call a rebate, or it comes with a cost, or what you hear terminology is called points. Occasionally an interest rate will land where it's even and it doesn't cost you anything or does not give you anything back. So as of Friday, on a regular 30-year conventional loan, our pricing was for 7.5 was costing you 1/8 of whatever the loan balance is going to be. Okay, so on a $100,000 property, you would take, if you were buying a house for $100,000 and you were putting 3% down, so you would have $97,000 times 0.125%. So in that scenario, you would be paying $121 extra cost for the rate of 7.5. Or on the flip side, if you went at with a 7.625, you'd be getting a credit of $242.50 on that same loan situation. Rates, you can go in these scenarios as high as 8.625, which would give you a credit of 2%, a full 2%. So on a $97,000 loan, you're talking 2%, so a credit of $1,940.
And let me ask you real quick, Rob. So that if someone were to decide to take the higher interest rate, right, with the hope of getting that, say, that 2% credit back, what can they use that for? Can they use that as part of the down payment? Can they use that towards closing costs, or is that just straight cash at the closing table?
Yeah, so it's a great question. So with that grant program, the maximum amount you can put down is 5%. Okay, but I've got customers every once in a while that we're going to put 15% down or 10% down, right? And I advise them, I can get you a much better loan if you go with 5% down, since you were going to put down more than that anyways. Let Rocket buy your rate down for you. And in that circumstance, on the same situation, they'd be paying 6.875 for the rate, and they're not paying for it because Rocket did. So that was lowering their rate by 0.625% for free. Or they could take the 8.625, and instead of getting 2% back in the form of closing costs, to pay closing costs or whatever, they can get 4% back. The only thing you can't get is you can't get money from those credits, can't be in the form of cash paid to you after the loan closes. It's got to be used towards the loan.
Okay.
But so there's a lot of flexibility. And I'm sure there's probably some question as to why would I take a higher rate or why would I go in those directions? All right, so I can use my own personal experience as a pretty good example. When I bought the house that I'm in today, I knew, because I already owned a home that I was going to sell, but my wife was nervous about putting our house up on the market and then not having a house because someone wanted to buy our house before we found one.
Yeah.
So I said, hey, that's fine. We can definitely afford to buy another one, and then we can take our time and sell our existing house. So that's the direction we went in. So when I did my loan, when we found this house, I told, because you're not allowed to, as a loan officer, you're not allowed to do your own loan, which kind of stinks.
Yeah.
It'd have been nice if I could have. So I told the loan officer that was doing my loan, I said, I want the highest rate possible. And they're like, what? And I'm like, I don't want to spend any of my money to buy a loan or to, get a loan that I know is not going to be in existence for more than 6 months. It's just throwing money down the tubes. I'd rather have a higher payment for 6 months, knowing I was going to refinance that loan once the other house sold. And that's when I would worry about what the rate was going to be. So I moved into this house. I didn't pay any closing costs at all. All I paid was the down payment because I let my rate pay for the closing costs.
Wow.
So there's some, and then in the world of, because this is about investing and how to create more wealth. If you do a lot of digging online, you're going to find that, and it's a little tricky because with investment properties, you have to put at least 15% down. Yeah. But if you're going to buy a primary house that your goal is to convert to a investment, then you can get away with the minimum 3.5 or 3, depending on the situation. And then if you're not a first-time home buyer with conventional, 5% will be your minimum down. But you're going to see, if you do some research, some of the smartest and richest people out there that make money off of real estate will tell you, don't take on the risk, let the bank take on the risk.
Yeah.
And what they're meaning by that is keep your money, as much of your money in the bank as possible. Let the lender take on that risk.
Yeah.
And what they're saying is, because if you take, let's just say you had $50,000, but you're getting ready to graduate from graduate school and you're going to get a job and you're going to be making $200,000 a year, but you still want to be a little conservative. It's your first house, so you're like, I'm going to buy a $200,000 home. Let's just throw that as an example, right? And you've got $50,000 plus in the bank. Your instinct might be to put $50,000 down and have your mortgage be based on $150,000, because it helps you get rid of PMI, which PMI is not some evil thing, but a lot of people will tell you that it is. It's just another cost. It's basically just look at it as interest. But what will happen is you'll put $50,000 down on that house, right? Well, the problem with when you do that, the only negative to that is that 50,000 portion of your equity is not growing.
Yeah.
That money does not grow. The house does. The value of the house will grow, and the amount of appreciation will grow, and the amount of equity will grow, but that $50,000 is not making a penny, making zero. You'd be better off taking 10,000 out of that 50,000, putting it down, take the other 40 and put it into some type of investment account and let it grow at 9-10%, and then let the house grow, especially these days, at 10%. And now you're getting the best of both worlds.
Yeah.
And when you put that into an investment account, that 40,000 that you didn't use to put down on the house, if it's not in a retirement style account, if the poop hits the fan, so to speak, and things happen and you're like, oh, the payment's getting a little bit hard, or something happened, you got in a car wreck, well, that money's always available, and you're not going to get penalized for using it.
Yeah.
If it's not in a retirement account, that money's still there, but it's growing for you. and working for you instead of you putting it here and the only thing you did was lower your monthly payment a little bit more. And the other problem going that direction is we're creatures of habit. You lower, you put the 40,000 down, you're saving $200 a month more in payment. I'm just guesstimating on that, but you're saving that $200. Well, that $200 of savings, now you find out you need to get a new car, right? And instead of getting the $400 a month payment, you get the $500 because that money will disappear.
More money, yeah.
That savings part of it on a monthly basis will disappear unless you're. And now there's some of us that are extremely rigid and strict. I'm not one of them. I'm not like I'm just not a constant everyday look at my bank account type person. Like I'm a little bit more emotional. So I know who I am and I accept that. Some people are really good about being super disciplined. And for those people, then it's different. But I still would recommend, and I wouldn't take my word for it. I would just do some research. But you're going to find that most people are going to tell you, let the bank borrow the bank's money to get the house and the appreciation. Keep your money over here in investments in other places.
Yeah. Awesome. Thanks so much for that, Rob. So, so just to kind of dive deeper a little on that subject. So talking about the different products that Rocket has. So I once read you had a 1% down program. Is that still a thing, or is that based off of the 2% grants out of the 3%, or is that a product by itself?
No, that's the Rocket one is the 2% grant.
Okay.
They say it's 1% down because that would be the minimum that you would have to put down.
Okay.
Only because Rocket's picking up the other two.
The other two. Okay. And for that same program, if you opt for, say, a higher interest rate, you can still get up to an additional 2% back towards either your closing costs or your down payment, correct?
Yeah. Yes.
And on that same program, are you still allowed, if you negotiate with the seller, to have like a seller concession, maybe up to 3% on the price? So
That's
in
correct.
theory, if someone were to go with this kind of program, they could, in theory, use a 2%, the original grant, pay down the 3% down payment to 1%, and then for the remaining 1%, they could go for a rate that is a little higher to take care of that. And then they could still go ahead and get a 3% seller's concession towards the closing cost.
Almost, but that 1% you are still required to put in at least.
Okay.
You have to commit to they call it your minimum required investment, your MRI.
Okay.
Or yeah, every loan has a minimum required investment.
Okay.
So without, like, if it was just the 3% first time home buyer, not doing the grant, but just the home ready product that we were looking at, the area median income, your minimum required investment into the house in that loan is 3%.
Okay.
For FHA, it's 3.5%. For Rocket One, which is the 3%, plus you get to subtract 2% because of Rocket's grant, your now medium or minimum required investment is only 1%. But yes, on with the conventional loans, you can get 3% seller concession. So that in that scenario, like with Rocket One, to where you could be buying a $200,000 home, and all you're taking out of your pocket's $2,000, and then the rest is being paid for you by either the seller or Rocket or whatever. If it's just the regular home ready type of loan with the 3% down, then your minimum out of pocket's going to be $6,000, but the seller can pay your the seller concessions, or you can take a higher rate and or a combination of the two.
Okay, awesome. So my next question, I guess, would be, are there specific kinds of properties you can buy with these loans? Does it have to be single family? Can it be a multi-family? Can it be manufactured? Like, what's the scope of that?
So it can be manufactured. I'm double checking. That's a great question. With the multifamily, it should still apply as long as it's between 1 and 4. But I'm going to look that up real quick here just to be on the safe side.
And while you're on that, I just want to throw, for those who may not be familiar with what a manufactured home is. It's sometimes called a mobile home, where it's not sitting on like a permanent foundation like you would have on a single family. I think I spoke about that in our webinar last month, but just in case some are not familiar with what that is, manufactured homes are usually much cheaper than regular, single family or multi-family homes, but then you have to pay the lease on the land. So that's just a little side note on that. But go ahead,
Well,
Rob.
and those properties actually have to be deeded. So they have to be on deeded land. So it can't be a lease situation.
Oh, really?
Yeah.
Oh, that's interesting.
A manufactured home that's not on where the owner of the house itself, the structure, doesn't own the land that it sits on, it's then you have to go through basically, in the generic terms for us, it's like you have to go get an automobile loan, essentially, something along those lines. However, they do have, it's more like a mobile home, like an RV type loan. So they do have loans that are structured at 20 years or longer on like a car. But yeah, in order for you to have what's called a mortgage loan, you have to own the property to secure that property, the deed to, in that mortgage. Because the mortgage itself, it's kind of funny. We call a loan to buy a house a mortgage, but really, it's just a loan. The mortgage is the document that, as the buyer of that property, gives the bank permission. It's going to be weird, to then secure and put a lien on the property until it's paid off. So the mortgage itself is actually just a document. But it's now just the terminology has becomes where that's just, yeah.
Yeah, I'm hearing that for the first time too.
Yeah. So back to your question on the units. For Rocket One with the 2% grant, the maximum loan to value on a 1 unit is 97%. So you pay 1, Rocket pays 2, right? On a 2 to 4 unit, so a 2, 3, or 4, the maximum LTV or loan to value, is 95%. So on a 2 to 4 family home, you'd have to bring at least 3% to the closing.
Okay.
And Rocket can pick up the other 2.
Okay.
With a product like Rocket One, and here's the thing also I advise.
Quick question, Rob. So is this 3%, is that like the minimum required investment for like the 2 to 4 family? Or can it be offset with maybe like rate adjustment or seller concession?
No, that's a minimum required investment. You got to bring at least the 3% out of pocket. And what they like to say is the actual minimum required investment is 5%, and that Rocket's helping you with 2.
2, okay, makes sense.
To get you to 3. When it comes to qualifications for a product like that, so since it's a conventional, what they call conventional product, which is a Fannie Mae or Freddie Mac backed loan, the credit requirements are going to be a little bit stiffer than it will be with, like, say, FHA. So what does that mean? Essentially, if you're by yourself buying the home, you are most likely going to need a credit score that is going to be somewhere in the 680 or above. Okay. If you are buying a home with someone else and your score, say 640, when I say your score, your middle of there's 3 credit reports. So the middle score and the one above it have to be at least not always, but typically 680 if you're by yourself. If you've got a very well qualified borrower and yourself, and let's say their scores in the 700s, yours are in the 640s, you should still be okay because of that 700 plus borrower. Mm. But my recommendation is, no matter the scenario, I'd recommend anybody who has any interest in ever buying a home, if they haven't gotten an application to do so, I would recommend doing it immediately. Mm. Even if it's something that there's no way you're going to do for a year. Mm. Here's the reason being. It's better to know where you stand today and where your target is than if you know your target's going to be buying that house, but you don't know where you stand today. Like, what kind of money am I going to need? Where's my credit now? What am I going to need to do to get it improved? It's better to get this stuff and get it out of the way now so that you can set up a plan to get you to where you want to go. Because the last thing you want to have happen is, I've still got another year of school left, and you get to 9 months from now and you're like, all right, and you start looking at houses and you find one, you love it, you go and you try to go get pre-approved in. They're telling you, unfortunately, your credit's nowhere near high enough, and we're going to have to get some work done. It's going to take 2 or 3 months. And there's no guarantee in that. Like, just because of it could take a little bit longer, could take less, just depends on the scenarios. So that's what my recommendation, no matter who you want to work with as far as a lender goes, get out in front of it, know where you stand. It'll make your life easier. It'll give you purpose. It'll put you on a path. It's just like, you don't go to school and just take classes for the hell of taking classes.
Yeah.
I mean, some people do, I guess, but usually most of you guys on here probably have a destination that you're trying to reach. But you had to start somewhere. And until you sat down with the counselor or sat down with somebody that kind of went over the curriculum, you didn't really know where you stood. You could have tested out of things. I'm sure a lot of you guys did.
Yeah.
So I highly recommend that.
Just to add to that, Rob, I think that's particularly important because, like you were saying, a lot of people make that mistake just because they don't feel ready, they don't take action, and I think that's in itself is a big problem, because when you and I had the same issue also, so I would just be like, blowing off my credit cards, because I didn't think I was going to need to use my credit score anytime soon. But eventually when I discovered what the requirements were, I had to start paying off, a bunch of cards and stuff like that. So I think it's really important, even if you don't think you're ready to buy a house today, and the beautiful thing about talking to, a mortgage loan officer like Rob, is that it's absolutely free, right?
Yes.
You're not paying, a dime. So you can basically, it's just like free consultation. You can reach out to him and just say, hey, this is my situation. Where am I, in terms of readiness to be able to get a mortgage? And the beautiful thing again, with, guys like Rob, is they don't always have to do like the hard pull of your credit, report. They can do like a soft pull that's not going to affect your credit score. So they can still give you an estimate of where you are and where you need to be ready to qualify for the kind of mortgage that that you want. So thanks so much for that, Rob. You kind of touched on it a little, but can you just give us like a run through, if someone were to apply for wants to get a mortgage with Rocket, for example, what would that process look like? Just like a brief run through, from just step by step. What would they expect? What are the hoops they expect to jump through?
So the first thing I was going to say, especially on this subject, because it kind of goes right along with it, every single person that I work with and that I've worked with over the 20 plus years now, almost every single scenario, every single person, every single couple that I've helped, there is always something unique and different about each one. Your profile as a person or as a couple or whatever the situation is always going to be unique. So, and that's another reason why it's difficult to give, and I'm not gonna, this doesn't have anything to do with the application process, but like just in general, when it comes to lending, is another reason why it's really important to get talking with somebody sooner than later so that you can explain all, just like Richard, for you, citizenship. So far this year, I've worked with people in the past that you would potentially be the second person in this calendar year with citizenship differences, right? And within that realm, which we've talked about a little bit already, there are varying degrees of what a non-citizen, what status you're in and what status you have to be in, or what documents you have to have. And there's timeframes that if you request a visa or request certain things, that it's not like you just walk into the government office and they're like, oh, here's a card for you.
Yeah.
You're good to go. I mean, it takes a couple of months, or it can take 6 months, or it could take longer, because you got to meet different requirements. So that, again, is another reason why you want to get fact gathering sooner than later. Back to the application process. So you're reaching out saying, hey, I want to see where I stand. I want to see if it's possible today, or, it might not be for a year before I'm ready, but I want to know where I would stand. So I want to go ahead. So what I would do is I would, depending on which works best for you, I would either take an application over the phone and enter it, or if it was something where, because of work and everything you have going on, I would send you a link to my application portal and allow you to fill out information as best you can on your own time. Then once it comes through to me, then I basically will text you or call to set up a time to verbally go over the information that was put in the system. What's typically going to happen if you're someone that is going to be ready here in the next couple of months, I'm going to tell you at this point, all right, so we're going to need to get income documentation, whether it's income that you already have coming in, or whether it's a job that you're going to be getting here once you graduate and you've already gotten an offer letter that you've already accepted, which we can actually use that as long as you're going to start working within 60 days of the day you close, which is kind of cool. We're going to go ahead and get the documentation. So documentation is going to be income verification, which will consist of an offer letter in that scenario, or if you're already working, or a combination of both, pay stubs, recent pay stubs, your W-2s for the past year, sometimes past 2 years, depending on the circumstances. If you receive overtime or bonus or commission income, I'm going to see if you have access to your year-end pay stubs from the previous years, so that I can break down those income categories to give you the most income possible, which will strengthen your ability to, it doesn't necessarily mean you need to buy more house. It just gives you a better debt to income ratio, makes your whole profile look better, and it makes your loan go through smoother, which is why we'd want to look at all those aspects. So once I have all this documentation, and then the other aspect to it is the assets. Where's the money going to come from for the down payment and potentially closing costs? And I'm going to, if you're like, well, I've only got $5,000 in the bank right now, I'm going to say, okay, is it possible for you to get a gift from a family member or a very close friend, or a school or a church? Because those are all possible gift donors. Once I plant that seed, all of a sudden, what happens a lot of times is, I'm like, hey, you don't have to answer me now, but just give it some thought and see if there anybody in your life that you think would want to help you out. And be surprised at how many people would initially say no, and then I get a call back a couple of days later. Well, my grandma, she didn't tell me that she was going to give me money when I got done with school. So that just happened to come up in conversation, and now all of a sudden the money's available because your grandma knows that they're graduating soon, and she was going to give it to them the whole time anyways, right? So that's why I like to plant that seed, because you just never know. Once we find out where that's going to come from, I will issue the pre-approval letter, which allows you to then talk with a realtor and start looking for properties. I mean, you can always be looking on your own, but if you want to engage a realtor, they're going to want to see a pre-approval letter before they start taking time out of their day to work with somebody, just because there's only so much time in a day. At that time, I can also take that income and assets and send it to underwriting and get what we call a verified approval letter, which is an underwritten approval letter, which only strengthens your offer, because you're taking away the uncertainty. The uncertainty. The seller feels a lot better about accepting your offer because they know you're good for it, right? Yeah. So once you go through that process, you find a property, they accept your offer, you'll sign a contract. At that point, you'll let me know if not ahead of time. who the realtor is, but if I already know the realtor is, the realtor is going to send me over the contract. I'm going to send you out loan disclosures, which is all that's going to do is just say, hey, here's your loan. This is what how we set up right now with the payments, the interest rate, everything that goes along with it. And it's going to disclose to you certain items that the government makes us disclose, that some of it doesn't even, really apply to us, but they do it anyways. It's government. But you'll go through and you'll sign those disclosures electronically. All you're doing is acknowledging you received them. And we'll also talk about the interest rate. Do we want to lock that rate in today? And what that basically means is when you lock a rate in, you're saying, okay, I'm good with that rate, good with that payment. But also, you're locking in a day and time. So any rate is available that was available for you on that day, you can change your mind up until about a week before closing, right? So in that example, let's say you were struggling on the money front. The seller didn't want to give you any concessions, and you just had enough for your down payment and closing costs, right? So you're like, well, I better take that higher rate for now and just hope to refinance it down the road 6 months or so. But then you find out that you've got other people that have been wanting to give you money that you didn't know about, right? So now you're like, well, I don't need that 8.625. I'd rather take the lower rate and we switch it down to 7.5, whatever the scenario, because you found out you have more money than you thought you did, or whatever however every scenario is going to be different, but whatever your situation is. So you lock in the interest rate, and it's typically locked in for a 30-day period, because your contract's typically going to be a 30-day contract, meaning from the day that the day that buyer and seller have signed on it, the loan you'll close and own that house within 30 days. If your situation dictates you need longer than 30 days, or the seller sometimes needs longer than 30 days, your contract could be 45, it could be 60, but you'll have an end date to that contract. We're going to work the contract, though. My goal on every single one of the files that I work on is I want that thing as clear, if I can, clear to close within 2 to 3 weeks. I want you to go and take all the stress off your shoulders worrying about, especially on your first home, but even if it's your second, I don't want people worried about whether or not they're going to qualify or get into the house, because it's like until it's over, there's always that something. You're always worried there's something's going to happen. So I'd like getting it done, and I love to be able to call the listing agent, so the realtor representing the seller, so they can tell the seller, hey, we're ready to close whenever you guys are. And there's not a better feeling for everybody.
Yeah.
And you may not close for another 2 weeks, but at least you know you don't have to worry. As long as you don't go out and buy a car between